we have John and Ted here. We don't have a lot of repeat speakers. And John and Ted we've had every year for the past few years. And the reason for that is the M&A process can be really, really confusing. And a lot of M&A people, when you talk to them and ask them to explain what's going on and how this works, it becomes even more confusing. So what I like about John and Ted is they demystify the process. They help you understand what it is, how it works, how much it costs, what you're going to get out of it, all that kind of stuff, and just the pros and cons. And like Jim was talking about with taxation, it's like, not wanting to pay double taxes. It's like, well, you didn't talk to somebody. So John and Ted are really, really good at helping people understand the process. And so that's why they're here. So it's all yours.
Is that clicker on? Okay, super. Thank you, Rick.
Thanks, Rick.
Hi, everybody. I'm John Wagner. This is Ted Rieple.
Nice to meet you.
We saw that a number of people are here for the first time, so Ted's going to take a minute to explain our firm and what we do and how long we've been doing it.
Yeah, thank you very much for joining us this afternoon. As far as the firm goes, we've been around for 15 years. I started it 15 years ago. John actually joined us 10 years ago. And we're international. We've got a lot of operations down in Latin America. We work in North America. We've done about 1.3 billion in total transactions, so we're well versed. Our specialty is the lumber building material market, so we're excited about that. And I think as a firm, from my standpoint, I know John feels the same way, that we're different than the average financial advisor or investment banker that you see. We've really got ops background like yourselves. In my particular case, I had 20 years in the specialty chemical industry. I ran, in today's dollars, about a $500 million business. After that, I started an industrial distribution company and ended up, after 7 years, taking that public. And then so I've had 3 jobs. Then I started First West Mergers and Acquisitions. John, do you want to give a little background on yourself too?
Yeah, I actually came into the building trade as a journalist, and then I got into marketing. I worked for MyTech for a number of years, and then served a lot of the MyTech portfolio companies in business development. We ended up selling 3 software companies to MyTech, and then Ted and I have had quite a run in the lumber and building materials space, again, through the connections we've got through just knowing the magazine and knowing Rick. Rick and I have actually started businesses in the past ourselves as well. So long time in the industry, a lot of knowledge about building products, and then the accrued knowledge that we both have with finances. And believe me, selling an LBM company is really idiosyncratic. Net working capital, accruals, inventory management, obsolete, slow-moving inventory at close, all those things are very, very specific. And not just, and I'm not just saying this, but not just any investment banker can sell businesses like yours. We're specialists indeed. You go on our website, you see press releases about our past deals. We're having yet another record year this year in terms of our, not number of deals closed, but in terms of revenue, meaning that we're selling larger, more powerful companies. And we expect, we'll get into this today, what's happening with private money right now. So there's our photos. We're super easy to find on the web. We're going to cover 4 topics today. What's happening year over year to gross profit dollars and how that's affecting your EBITDA with the fall off of commodity lumber pricing. Second, we're going to have a little fun here. I have an auctioneer's hammer. We're going to have a little pretend auction. We're going to auction off 3 pretend companies and see if you can guess the multiple that was paid for those. We'll look at the economic conditions, again, what's happening with interest rates and where the private money is flowing and why. And then we'll give a prediction for 2024. This will take 3 to 4 hours. We're going to skip the NASCAR thing. So we'll have sandwiches and coffee. Gross profit dollars. Ted, why don't you take this one?
Yeah, it's interesting. I think if you look at the market, it's changed, and each of you have been through it, so you know what we're talking about. I mean, as lumber prices went up to, what, $14.40 or whatever, obviously what happened is that in most cases, the gross profit margins, at least in the companies that we represented, pretty much stayed the same. So they got that higher gross profit margin, or that same gross profit margin on a higher COGS. So as a result, gross profit dollars went up, EBITDA went up, but now in 2022, or in 2022 going on 2023, the majority of the things that we're looking at now are showing a decrease both in gross profit dollars and EBITDA, even though the gross profit margins still relatively remain the same.
So you don't have to show of hands because you'll be revealing your financials, but I'll bet that everybody here is slightly down. If you're not down 2022 over 2023, you're doing really well. Acquirers know this, and a lot of the people we do valuations and we do sales of company, a lot of the acquirers will recognize you're doing maybe the same, even the same volume, but you're making fewer gross profit dollars and therefore less EBITDA. So it's nothing to be ashamed of if your EBITDA is off 15% year over year and you're down. Don't feel bad because the acquirers all know that. What was happening in 2022 when we sold companies is that we were discounting the EBITDA in concert with, in agreement with the acquirer, because everyone recognized that EBITDA was inflated because of the commodity prices. Exactly. So now we're trading at whatever, between $400 and $500. It was $14.40, whatever. Everyone knows what's happening there. So don't be ashamed if you're year over year down. The acquirers, even if they bought it in 2022 numbers, we were discounting the EBITDA to account for that. Everyone knew it was a sugar high.
And it really depends, too, on how much commodity business you really have got. I mean, some of our clients have typically, 30 or 40% in commodities, but we've had some, clients that are, 60, 70% commodity, and they really got hit with the price decrease. I think the important thing, and when we went through that, just so you know, too, it was really important, because we were negotiating deals during that whole time, but the big deal was that anybody buying a company, they knew that the price was going to come down again back to pre-pandemic levels eventually. So what we had to do was really develop what we call the price effect model. It took us almost 2 months, and we put a lot of time and money into it, but we could basically tell exactly what the sustainable EBITDA was, taken into account what the commodity prices were up and then as they started down. But so anyway, what we've got now basically is really, the gross profit dollars were high, EBITDA was record highs, and all of a sudden, now it's going down. So you're with everybody else in the industry.
Right. Part of our job is not just doing financials and putting together deal books and shopping it. It's managing the emotion of the seller. A lot of people looked at those 2022 numbers and said, well, this is going to go on forever, and I want a high multiple based on the 2022 numbers. So we really have to, we're simply honest with our clients. We said, look, you're not going to achieve that.
Right.
And people are disappointed to see that because they knew it would come off. And when you take 5 times the 15% difference on a $6 million EBITDA company, it's real money. So we had to really just, really tell our clients what's really happening out there, what private equity groups are willing to pay and why.
Yeah, and if you looked at our client list for the last couple of years, during that whole run-up, we had clients that were doubling their EBITDA, in those years. So, it was a big rise. And no, I don't think anybody really fully expected that was going to last. But anyway, we dealt with it, and we got through it, and we got deals done.
You bet. Okay, so we're going to have a little fun here. I got an auctioneer's hammer. I had to check my bag to get this from Santa Fe to here. The TSA guy said we barely let investment bankers on the plane, and we don't let them on with weapons. So you have to check your away bag, and so I did. So we're going to have a little fun here, but this is serious business because there's millions of dollars at stake. We have a book that we give out, and we're gonna just on our system see who gets these right, and then give me your card and write book on it. Anybody can do that actually, and we'll send you a copy of the book, our most recent book. Okay, so what values did these hypothetical companies attain in an acquisition? Here's deal number 1: $40 million in sales. 60% of their sales were commodity lumber. That's really high. And we actually sold a company recently that had 70%. Okay, so it's low margin, you're beating up your trucks. High customer concentration, meaning of their top 20 customers, a disproportionate amount of their sales were to a few of them. If you have some volatility there, they get poached, you lose a sales guy with a book of business. That is what private equity groups will look at. We're doing this from how a buyer would perceive you if you had these key performance indicators. You have an EBITDA of $3.2 million. That's actually really good. You can readily sell a company like that. But notice, and this goes back to Jim Sobek's point, it's sub 10% EBITDA margin, okay? 8% EBITDA margin, high commodity, high customer concentration, but really good top line. 40 million is pretty good. What multiple of EBITDA did this company achieve in an acquisition? Now. 2023, right now. And my bid 3x.
Come on.
There's some 3X's.
Okay, we got some 3X's.
Anybody want to go with 4X?
Whoa.
Okay.
It's going up.
There's
3.2 million was
23,
that was 23 numbers, though.
trailing 12.
Yep.
Consider it trailing 12.
12.
Yeah. So price effect is out of the EBITDA. Consider that. Okay. Back here. So we got some 3X votes. We got some 4X votes. 5 times the EBITDA.
Oh, we got some 5X's.
Okay, some risk takers. I'm
Good.
not going to Vegas with you guys. It was sold for 4X. Okay. So,
Who got the 4X right?
and who got the 4X right?
Oh, they get bucks.
That was, and you're about right. So Jim was talking in his presentation about private equity groups paying 2.5. That would be a net asset value sale, and that's a distressed sale where they're buying basically inventory AP, and that's slightly different. We typically sell companies in that high 4s to around 6X is where our clients land because they're good performers, and we kind of warn them ahead of time. So now that's a 4X. If you are getting offered 3X for your company, most of the time our clients will say, well, I'll just run the darn thing for 3 more years. Why would I sell at 3X? So 4X is really where it starts to make sense to sell. And again, you have to watch those KPIs. Okay, here's deal. All right, this is the examination. Just going back to those metrics, you can see again. Good sales, a lot of commodity, high customer concentration. Those 2 things work against you. Nice EBITDA, but only 8% EBITDA margin. All right, deal number 2. 25 million in sales. Right in the middle there in terms of what percent of their products are commodity products, 45%. Tiny bit high, but that's still not too much. You've got other higher margin products for the other 65% of the company, 55%. Low customer concentration, meaning across your top 20, 25, 30 customers, you have a nice diffuse percentage of the business among those leading customers. A 2.5 million EBITDA, but a 10% EBITDA margin. In your business, that's really healthy. We've sold companies as high as 16% EBITDA margin, but they had windows, millwork, they had those higher margin things. If you're doing 10% EBITDA margin and you've got 45% sales of commodity, nice customer concentration, you have a pretty nice business. What multiple of EBITDA did this company achieve in an acquisition? 3X. No takers.
No takers.
4X.
No takers.
5X.
Whoa.
A lot of hands. 6X.
Ooh.
Ooh, okay.
Thank you.
7X. Nobody at the top.
Oh, we got 1.
And we got 1 to 7X. You're a risk taker, okay. This one would have sold for around 5X, okay? Let's go back to the KPIs again to see why. So even though it didn't have the sales of deal number 1, it had that 10% EBITDA, which is a threshold for high performance. It had the low customer concentration. You're not selling quite as much commodity, so there's not a lot of volatility there. And you had a 2.5 million EBITDA, which again, it's sub 3, but still a very nice EBITDA to go out and sell a company with. Deal number 3, 50 million in sales, low sales of commodity lumbers. 35% is a low number relative to the customers we see. Moderate customer concentration, 6 million EBITDA, and a 12% EBITDA margin. This is an elite company, right? So you got 6 million EBITDA. What multiple did this achieve in an acquisition? 3X. There's no suckers in the room on the 3X. 4X.
Ooh.
5X.
Ooh.
6X.
There we go.
There's the top of the crown. And 7X.
Ooh.
Okay.
Nice.
This one probably today's market with, we'll talk about debt and inflation. This one would have sold for a solid 6X and maybe a slight premium on that if there's an earn-out or some leverage or whatnot. So excellent. And who got all 3 right? Very good.
Wow.
Who got 2 right? Great. And 1 right. You don't have to do it, Larry. Anybody who wants a book, M&A for People in a Big Hurry, just give me your business card, write book on it, and I'd be happy to send you a copy. We're going to go to the next part. So here are the deals in combined form. So notice that the deal with the highest sale, the $40 million, actually sold for around the same amount as the $25 million sale. See, it's sensitivity to that EBITDA margin and your percent commodity. It's high, the value of the company is highly sensitive to that. So from an acquirer's perspective, looking at these, they're not just going to look at your sales. We've gotten phone calls to say, I'm killing it. We have 60 million in sales. And we'll say, what's your EBITDA margin? No, 4%. So it's not just your top line value, it's how efficiently you're moving money in those gross profit dollars and EBITDA lines. It's not just your sales. And this is how an acquirer would perceive it.
Yeah. You know, a lot of the things that really play into this whole valuation thing is when you're selling a business, and I think Jim mentioned it too, is leadership continuity. That's critical. And typically, you know, if somebody says, I'm going to leave in 3 months, it's not going to happen typically. So normally a year minimum and maybe a couple of years. So I think when you're thinking about selling your business, and Jim had mentioned that too, you really need to think about how long you want to stay. We've got people that want to stay in the business on an ongoing basis, and a lot of it has to do with age too. We've got a couple of people in the 40s and 50s, and basically they want to recap, take some chips off the table, and then basically reinvest that back in the private equity group if it's private equity. As far as other KPIs that really count though, besides leadership, is financial controls, AR aging, inventory turns, all that kind of stuff. Net working capital plays a big role. John mentioned a little bit about we really track that very carefully. And once we get into it, there's innuendos to the whole thing. So you want to really be on top of it, and you want to know it right away when you're doing the deal. Inventory practices. A lot of times we run into, is it going to be a stock sale or an asset sale? Typically there's not a big difference, not a huge difference, but we sit there and we compare both stock and asset. As far as expectations on a triple net lease kind of deal, we make sure that everybody understands that. Your manufacturing and the value add services, that's a big deal. If you've got millwork, doors, windows, that really add to the gross profit percentages, gross profit dollars, and that's how you get your gross profit margins maybe from a 25% up to a 30%. So there's other things, but all these things come into play.
Right. Quick note on real estate is that if you're being acquired by a private equity group, and we've done deals and/or solicited bids from, negotiated with USLBM, Builders First Force, TAL, all the leading ones, they don't want the real estate. You will become a landlord. So make sure that the real estate's not in your business, spin it out into an LLC. I'm sure most of you have that now, but if you're going for an acquisition, don't have the real estate within your business. Separate LLC. And then the private equity groups especially do not want the real estate. You will have a triple.
And one other thing too is make sure when you're looking at your rent that you're charging yourself fair market value for that rent. Because if you don't charge yourself fair market value, when you get to the sale of your business, if your rent is way low, what's going to happen is there's going to be a negative adjustment to your EBITDA, because they're going to want to increase the rent to a fair market value. Or you'd want to increase it to a fair market value too. So just keep that in mind, and we have it happen, John, all the time.
We have it happen all the time. Because if the family owns the real estate and the family owns the business, like why, I'm just handling money, why would I pay myself rent? We had a valuation we did with a company up in Midwest. By the time we adjusted for what they should have been paying in rent on 2 facilities, he was not profitable.
He couldn't do it.
He backed out of taking the company to market because he didn't have a meaningful EBITDA after that.
And we suggested he back out because we weren't going to be able to sell it. I think he thought, he basically wasn't charging himself anything for rent. And all of a sudden now when he put the rent in there, he was, it wasn't going to work.
His conclusion was he would shut down the business and just be a landlord. I'm not kidding. That was one of his options. He's like, maybe I don't have to work at all. Okay, Ted's going to take this kind of current economic conditions and how it's impacting values and sales.
Yeah, we thought you'd be interested. You want to go to the next slide, John, and take a look at how it's kind of the sauce behind why the private equity groups and why the investors are offering what they're offering. But one of the things, quite frankly, that's happening right now is and we'll see it in other future slides, but if you look at debt has become a really important part of doing a deal. If you're dealing with Kodiak or USLBM or any of the big guys, they essentially finance about 50% of the deal in debt. It could be 45% senior debt, probably 5% maybe sub-debt or mezzanine debt. So keep that in mind, that debt piece plays an important role. And we'll get into it a little bit later, but the debt thing has doubled since a year ago.
Cost of debt.
It's gone from 4% up to 8% or 9%. So all of a sudden, we'll talk more about it, but that'll help kind of explain what we're doing here. But if you look at this, you can see it. I mean, you've got the equity, and what's happened, there's more leverage being used in this case. Senior debt is 42.8% in 22, but went up to 48.5% in 2023. So they got more debt on the books, and that's good, but that's in that category, the $10 to $25 million TEV category. And equity was reduced actually from 48.8% in 2022 to 39.3% in 2023. So the buyer in this particular case, and these are current numbers, by the way, these are third quarter numbers. In this particular case, the buyer is getting higher leverage on the transaction. That's exactly what they want. But we'll go to the next slide.
One point is that even if it seems as though you're getting all cash from your private equity group when they buy your company, they will then recap that and put the debt on the business.
Exactly.
And they'll often take 2 or 3 deals together and go to Fifth Thirds or JP or whatever, and they'll finance the deal. So even though you're getting a check for equity from the private equity group, the cost of debt does impact your value because they're going to refi the deals a little later.
Exactly. So in this particular case, we're talking about deals that are 25 to 50 million TEV. TEV basically is total enterprise value or purchase price of the business. In this particular case, there's less leverage being used. Senior debt in this case went from 41.7% in 2022 to 33.5% in 2023, and the sub-debt remained the same. So the question becomes, and then equity increased from 48.3 in 2022 to 56.6 in 2023. So on that larger transaction, the private equity groups or the investors that are buying the business basically had to put more of their money into the deal, and that changes everything. And in this particular case, why would that happen? Because on the smaller size deal, they got more leverage. In this particular deal, on the bigger deals, the bank simply required more equity. It was a bigger deal. There was more risk attached to it. So this is what they're dealing with. I mean, that's the sauce behind what all these valuations. It's a key part of the whole valuation process too, because it was happened over the last, and certainly in 2023. The market has tightened up, and you've probably heard about it. We'll talk more about it when we get into what's going to happen in 2024. But the market's tightened up, and as a result, it's putting a lot of pressure on these private equity groups.
Right. So if you see that up to half of your deal is being borrowed, the value of it, I mean, that's still cash to you, the seller at close, make no mistake. But the private equity group, because they have to account for the higher cost of debt, that may bring your business down half a turn. So instead of selling at 5.8, you're selling at 5.2. Or instead of selling at 4.7, you're selling at 4.5. That can really affect that because it's a multiplier effect on your EBITDA, right? So if you're sold at 5x and you have $1 million EBITDA, you have a $5 million company, you come down half a turn because of the price of debt. That's a really meaningful diminishment of the value you get because it's a multiplier effect of that.
And if you're the investor too, the other side of that is a typical private equity group is looking anywhere from a 20% to 30% internal rate of return. They always say 30%, but they'll end up in 20%. And now it's going lower. So that debt is playing a major role in reducing their internal rate of return. So that debt thing really plays a big part of what's going on right now.
Right. So you will start to see, if we come off those higher interest rates and debts become less expensive, we saw the inflation rate stabilize today, Wall Street Journal article, lead article today. If you start to see those interest rates come down, that's an increase, a tiny amount, but still meaningful for the size companies you have, of value for you. So we want to see that happen. I don't know if the Fed's going to act in 2024 at all.
Yep. So this is kind of interesting. So I had mentioned just a minute ago in terms of the debt piece. So this is done by quarters. This is current, by the way, through the second quarter. But you'll notice, if you look at the second quarter 2022, it was at 3.8%. If you go over to the second quarter of 2023, it's 10.1%. So it's more than doubled. And the numbers you're seeing right there, that's based on 127 transactions. So it's a lot of transactions. If you look at all the transactions, that data represents 409 transactions. So it's pretty good data. It's pretty solid. But you can see here, a lot has changed from a year ago, and that's why you're seeing a lot of these private equity groups just didn't know what to do or how to handle it, and they basically kind of held off in the first half. That's why if you've seen a slowing in the M&A market, it's got everything to do with this debt issue.
Right. I'll point out that these tables are from a database we subscribe to called GF Data Resources. Right. Extremely dependable. We use them in every one of our deals just to back up our opinion of what their multiple should be paid. And again, to show our client that they're not getting below market. We subscribed to this for years. For longer than I've been with you, you've subscribed.
Yeah, it's the gold standard. You know, the problem with private transactions, which all of us are in the room are in private held companies for the most part, you really have trouble getting data. With GF Data, what they do is they actually collect data from private equity groups that want to participate in their program, and they do it voluntarily, actually. They don't mention the name of the company, but what they do is they identify the company through an NAIC code. So the data you're seeing here is actually real data, real transactions.
Okay, looking ahead to 2024, we'll just ham and egg this. So debt's really expensive, and so the cost of acquisition perceived by the buyer is going to remain high to them. Acquirers are going to try and recover that added cost through slightly lower purchase prices, reflected in a slightly below last year multiple, and then seller leverage. So seller leverage is when it can be an earnout where you get a substantial amount of your company value at close, and then maybe a year later you get 15 or 20% of that value if you achieve certain EBITDA performance or gross profit dollar performance. Smaller private equity groups will use a seller note where they'll borrow some money from you for a year or sometimes 5 years. That's typically 5% interest only. Balloon on the 5th anniversary is pretty typical right now. So the leverage tools are after your cash at close, there's always a 5% escrow for the deal value, and that's held for 12 to 15 months. You have a potential earn-out. Sometimes it's 1 year, sometimes it's 2. We have a number of deals now that are earning out from last year that are starting to pay. Those are 1 year earn-outs. And we have one deal right now that's entering its 2nd year of an earn-out. And they have worked out, but we don't like earn-outs at all, and neither do our clients, because you can't control wars in the Middle East, COVID reemergence, so high interest rates, the Fed being overactive in raising rates. So the earnouts, they add some unpredictability, and people don't like that, but sometimes that's the bridge to get to the value you want. So you have cash at close, earnout, necessary escrow, and sometimes a seller note.
So that's the current environment, and the debt thing we don't think is going to go away anytime soon. You know, it's all depending on inflation, and it all depends on a lot of various things, but we think from a debt standpoint, Powell is still working on the interest rate deal, and you know it depends on whether inflation gets down to that 2% target. And we don't think we think 2024 is still going to have debt. Hopefully it'll come down a bit, but this is going to be part of 2024, this debt issue, we think.
So another thing that's happened in this is that there's still a lot of fragmentation from family-owned businesses in the LBM space. A lot of choice companies that wanted to sell have sold. If you go look at the activity from US LBM, Kodiak, Builders First Source, TAL, Building Industry Partners, Nation's Best, they're snapping up some really great companies. And it's slowed down just a little bit. We're going to show you how it's going to come back. But a lot of the family businesses now, if the 3rd or 4th generation is taking leadership and wants to run the companies, you're starting to see that, but there's still probably numbering thousands of independent, successful businesses that have, really good EBITDAs, and so M&A will continue for a long time to come. It is not. You see some news now that Bain is selling 49% of US LBM after holding it for a certain number of years. You'll hear all kinds of rumors of what's going to happen with that, and with other private equity groups. But make no mistake, you haven't missed an opportunity per se if you haven't sold now.
Yeah, and this is the way it is, but we've got some better news for you as we go through here. So I think you'll be happy.
Take this one.
This is important. This is the 10 and 10 companies. Jim brought up about the 10%, getting the 10% EBITDA margins. 110 stands for being at 10% EBITDA margins or above and 10% growth. And if you get into that category, they consider you a highly financial performer, high financial performer. And just so you know, if you're in that 10 and 10 range or above, you're typically getting about a 20% premium on purchase price. It's a big deal. You take 20%, it's a lot of money, and when you look at the total, your total EBITDA, you multiply times the multiplier, then all of a sudden you add that, you take that times the 6x or 5x, and then you increase it by 20%. That's a big deal. So getting to a 10 and a 10, it's a rule that everybody applies to, and it's not just Jim, it's not just us, it's the financial community in looking at that 10 and 10. Because they really, at the end of the day, they prefer, there's less risk for a financial performer. They obviously have their books in good shape, they're doing all the right things. So this thing becomes really important, but I would keep in your mind that you're looking at about a 20% premium when you sell your business if you're at that 10 and 10 rule.
And we've seen that spread on the multiple paid for these companies quite wide. We sold a company, very high commodity, kind of one of those sample companies. Those are fake numbers, of course. But they had a very high commodity rate. They didn't have great inventory systems, but they had an okay EBITDA, and they sold for 3.7x. And that was really all we could get after a substantial auction. And then a company around the same size sold for 5.85x. And the difference there is that growth and the profitability, the year-over-year growth and profitability, it can dramatically affect the value, and as is obvious in what we've seen in selling companies.
Despite these trends in 2022, the first half of 23, things are not as bad as they appear. So that's the good news. We're going to talk a little bit about that. Because I think when you look at the numbers, you go, oh my God, when am I ever going to be able to sell my business? Well, that's not too far off, I can tell you. But the data is biased because a lot of the stuff you're hearing about mergers and acquisitions are by these large deals that are getting done by private equity groups that have nothing to do with the lower middle market, which we're all in here. So just so you know, the juice is now in the lower middle market. There's a lot of transactions in the second quarter and going into the third quarter. There's a lot of transactions that are going on in the lower middle market right now because people were on the sidelines for the last year, basically not selling their business. And they've decided that basically now is a good time to sell. It may not be the perfect time to sell, but what's going to change in 2024, and we're going to show you some of that right now.
Before we go to that, one thing about how long it takes to get your business on the market and sold, it's 5 to 6 months. It takes a month to get ready, and that's assuming your inventory and your software and your HR is all in line, and you've got good books and good financial discipline in getting us, our investment bankers, your income statements and balance sheets, and we have to model your working capital. It's quite involved. It takes about 30 to 45 days to get the deal book done and get on the street. Then it takes about another 3 to 4 weeks to solicit the various bids and get the Kodiaks and the Builders First Sources and the other private equity groups involved. And then it's a little bit of an auction, and that's where a lot of our skill comes in leveraging and trying to get up once LOI numbers are declared, and you kind of work people against each other a little bit. Not that anybody from Kodiak in the room or at USLB wants to hear that, but that's just the way the game is played. Then if you're in exclusivity with one buyer, now you're almost 2 months into the process by the time you've got a selected prevailing acquirer. Then it's 90 to 100 days in due diligence, and then it closes. So it's a solid 5 months. So if you're thinking about selling and you want to sell mid-year next year, count back 5 to 6 months from that, and it's quite a time-consuming process.
Right, and count on the fact that our goal is always to get the most recent financials. So typically, what we always try to do is do it on a trailing 12-month basis. So if you decided you wanted to sell your business today, and as John just went through, it might be 6 months before it actually sells. We're going to try to run your numbers all the way through that 6-month period of time, because hopefully your sales were going up, your EBITDA is going up, and you'll end up with a better valuation. So the point being is that if you're thinking about selling, think about where you're going to be in 6 months, because that's the number you're probably going to get paid on a trailing 12-month basis.
So if you've got a rising EBITDA going through that due diligence process, there won't be pressure on the buyer. Say, you know what, the worst words you want to hear in the world is repricing after LOI,
right,
where the price has been set, and then you're slipping on EBITDA, you're slipping on margins, and then the buyer calls us and say, I just got this thing, and you're like, oh my God, you're not going to reprice, are you? Yes, we're going to reprice after LOI, and we fight that like crazy. But you really want to be climbing in EBITDA through due diligence into close. Now, there's a couple ways to price your deal. If you dynamically price it for the trailing 12 EBITDA going into close, that's ideal because you're capturing all that increased EBITDA. But you also risk, if it's dynamically priced and you slip and your EBITDA is not as strong as it was when the LOI was written, you'll lose that money. So this is where our advice comes in, and we kind of handicap where you'd end up.
This is the big news. I think that, and there's another slide that follows this, but what we're seeing now is the potential targets has surged in 2023 due to the low deal of inventory and sellers willing to sell at the current economic environment. And we're seeing a lot of this in the lower middle market. And that's the sales of 10 to 25 million. But the reason for all this, and this is the news, is right now it's a record, but there is $2.5 trillion in dry powder in the United States of America right now with private equity groups. It's never been that high. Keep in mind that dry powder is from limited partners that put money into that private equity group to deploy and buy companies. And what's happened is the private equity groups over the first 6 months kind of sat there concerned about the economy, concerned about the interest rates, concerned about a lot of different things, and basically said the environment's not right. The problem is the limited partners basically have their money in there and they have to deploy it. I mean, they typically work on a 5-year turn on when they put that investment in, most will typically have an exit normally within about a 3 to 5 year period after that. So the private equity groups have a problem, and that money is going to get deployed, and we're already seeing it. And it's interesting because John and I thought it was coincidental, and then we said, no. And then we thought, something's going on. We were working on deals 6 months ago, a year ago, that just didn't go anywhere or were stagnant or whatever else. And all of a sudden, we won't mention names other than the fact that it's the big guys out there, coming back to us now and want to revisit these deals. And that's for exactly that reason. So there's a surge coming on, and it's coming, I can tell you. So you're going to see it in the fourth quarter, and you're going to see it in 2024. It has to happen. It just has to.
So when a limited partner, like a family office, puts money into a private equity group for them to invest, the private equity group charges them a fee of 1% to 2%. So they're losing that if the money's not put to use. Then there's inflation, so maybe they're losing between 4% and 6% on that. So those guys will say, well, I'll go buy a Schwab CD for 5.6%. Why am I parking my money there if it's not going to work? So this is Ted's point, is that there's $2.5 trillion. Again, this is a GF data, polling of private equity groups, and there's 1% being billed to the investor at that point, and they're like, look, just get it into something. Now, they're not going to be reckless, make no mistake at all, but the LPs pressure the private equity groups to put that money to work, and that money's at a record high.
Yeah, and the reason they're putting the money in the private equity group is for a good reason. They want a 20 to 30% internal rate of return, and they get it normally. So it's a lot of money. So that money, when it's sitting there doing nothing, that is not what the limited partners want. They don't want stupid investments maybe, but at the same time, this problem can be solved. And I think private equity is coming to that conclusion. I mean, granted, the debt has doubled, right? But the truth of the matter is they can buy a company and pay a reasonable multiple for that company. And in a year from now or a year and a half from now, if interest rates come down, they can recap that.
That's not all LBM, that's across all industries.
It's across all, but as you know.
LBM's relatively attractive, Doug.
Yeah, LBM is right in there, of course, in the case that because a lot of the deals getting done are with the big guys right now, the private equity-backed guys. So that's, but even the strategics are operating this way too. So this is a big deal, and I don't want to overstate it because we're pretty conservative, But in this case, John, when you have customers that are coming back to you and saying, "I want to revisit that," it changes everything. 18 months later,
12 months later,
they're serious.
Yeah. The other thing I just want to point out is if they're buying, if a private equity group is buying you at 5.5, so USLBM famously, when they first started buying, they were very disciplined. They were buying at 5.5, 5.5, over and over and over again. So now, if you look at, and just watch the news to see what multiple they're selling at, in aggregate, 1,200 yards is not selling for 5.5. Right? Kodiak, they're a $3.3 billion, $3.4 billion company, and Court Square is the owner of that. They're almost 6 years into that hold. They're not going to sell in aggregate at the multiple they purchased at. So those LPs who had the discipline and stuck in there, and they were buying at 5.5 and buying at just, in that 5 to 6 range, they might sell at 8x or 9x when in aggregate that company flips the new set of portfolio companies.
Exactly.
So that's, yeah.
That's the news. So I mean, we don't want to overstate it, but we really do believe, and it's being written up all over the place now about this surge that's coming. It's already started. So I'd go back and just say to yourself, if you're thinking about selling, you should think about where you want to be 6 months from now. If that fits within your plans, it might be a very good time. But there's another big reason too, and what we're finding out, there's not enough deals on the market right now as a result of what happened over the last year. So the buyers are they're scrambling to find deals. So there's a shortage of deals in the market, and that's just the way it is. So there's a shortage. We know the money's going to be there. So we think there's going to be a big opportunity in 2024, and we would normally never say that, right?
That's right. All right, so we protected a fair amount of time for questions, and I will repeat them into the microphone so everybody knows what's being asked. But are there questions? Your hands are tired from bidding. Your arms are tired from bidding. Yeah.
Workouts are normally done on EBITDA or growth.
Okay, the earnouts?
Or the workout, the earnout. I'm sorry.
The earnout. So the question is, what is the earnout based on? Is it based on the EBITDA, or is it based on some other KPI within the company? The buyers want the earnout to be based on EBITDA. So they say, look, we'll give you 15% more of the total value we pay for your company if you hit $2 million, imaginary figure, if you hit $2 million EBITDA over the 12 months after the close. We hate that. We typically negotiate the earnout to be based on gross profit dollars, because you're going to lose control of some of your company and your OPEX and your COGS. They may buy inventory a different way. So we have prevailed in I think, all cases where we said, no, it's not EBITDA because we lose control of that number. We base it on gross profit dollars. It's very rarely based on sales. It's usually what you do with your sales dollar. So we try and push for that gross profit dollar, and it's usually formulaic. The buyers want it to be a cliff. You hit the $2 million in EBITDA and you get the earnout, or you get zero. We intervene there and we say it's grade aided, and there's some pretty elaborate formulas there in terms of if you hit 85% of the target, you get 85% of the earnout amount. If you go another 5%, and we work those formulas again to try and protect our clients from slippage off that number. Because if you miss it by $1 and it's a cliff, you don't get the $2 million. But so we grade aid it, we based on gross profit dollar. That's kind of our strategy, and it's been successful. It's very fair too, by the way.
And we don't encourage earnouts. I mean, ideally, it's cash is king, right? So, but at the same time, sometimes it's required because they don't have the confidence that the business is going to keep going at the rate it's going, or whatever the reasons are. But anyway, but the important thing, like John said, is if we do have to get into an earnout situation, number one, we try to keep the number very small. Number two, we protect you so you don't get stuck with OPEX, because OPEX is going to be underneath their control down the road, and that's not good for EBITDA. So we do it on gross profit dollars.
You'll hear a term called a financially engineered deal. We had an offering outside of the LBM space. We sell other kinds of businesses. And there was a private equity group. They came in, and the way that they engineered their offer, and you don't see this so much in the LBM. We have more cash forward offers in this sector. In this particular case, the two fellows who had started their own private equity group and had some family money and some investment money, they were risking 20% of the deal value of their own cash. The rest of it was seller notes, earnout, and two kinds of debt. That's a financially engineered deal. They take very, very little risk, but a lot of that risk, because that debt is hung on the newco going forward, and if you've got an earnout that's heavily loaded with debt, that's an over-leveraged company. So sometimes you'll say, oh, it was so engineered I couldn't take the deal. So we really push for those cash forward deals. We fight the earnouts, but you will have the escrow. That's just in every deal.
The one thing we haven't mentioned is share roll. And with private equity, they love it. And it can be a really big deal too. And typically what they're looking for is that on a private equity deal, whether it's with the big boys or whoever you're dealing with, they'd like to see the owners keep in 10 to 15%, maybe 20% possibly into the new entity, which would be NewCo at that point in time.
How many people here in the room would like to have rolled shares with Kodiak, USLBM, or Builders FirstSource 2 years ago?
Oh,
You would have had a nice
made a
premium,
lot of money.
right? So as Ted says, there's kind of a request where they roll 20%, you roll 20% of the deal value. Now, typically the younger owners want to do that share roll because they know there's going to be maybe a 30% premium if they're patient, and there's a liquidity event by the private equity group that owns the buyer or that is the buyer. So they'll take those shares, and that's just part of the deal value. We consider that part of the consideration paid. We collect our fee on the rolled share value at the strike price at close, not over the future, right? And typically, our bank also, just FYI, if you have an earnout, we're not taking a success fee on your earnout until you get it. Right. Same with the escrow. We wait alongside you to take a fee on the money.
The roll can be a really nice thing. Of all the deals we've done, I don't think we've ever had one that I recall that didn't turn out to be at least a 30% return for them. So it's big money. Well, keep in mind, if you're private equity, basically they're buying companies at 5 or 6x multiple of EBITDA, right? You get to $2 billion in sales, all of a sudden you're selling that business for 11 or 12x EBITDA. So that's where you pick it up. So on exit, on that roll, that's when your liquidity event on a share roll, you may do the deal in 2023. Let's say in 2024 or 2025, let's say Kodiak or one of the other ones basically have an exit and they sell to another private equity group. You're getting paid right there on the spot. So, and you're getting the benefit of whatever percent you put in. So it can be a really good thing, but it's not for everybody in the sense that if you just want out, that's a different story. You don't want to be, you wouldn't want to be part of the whole roll deal if you're not going to be with the company.
Right. The other thing on escrow release, by the way, I don't think we've ever had an escrow reduced. When you put money in an escrow, if you're doing a $30 or $40 million deal and you do 5% escrow, you have to negotiate the interest rate with the buyer. But you think, oh my gosh, that's a lot of money at risk to sit there for 12 to 15 months. We've never really seen, the companies that we deal with are very well run, and we do our own diligence, and of course during due diligence you see you'd have to have a catastrophic thing happen to your company, an undisclosed sexual harassment suit, somebody who was in a car accident who came back and sued you later. For the most part, those escrows are wholly released after that 12 to 15 month period. It's not really at risk money.
And typically come back at 97, 98%.
Yeah, there'll be maybe a rep or warranty or a covenant that got tripped or something, and you sacrifice a small amount. But a lot of people are very nervous to let that money sit there. It's usually held by a third party, but those are largely released. So those are not risky places to park the funds. Yes, sir.
When you talk about PE firms wanting 20 to 30% IRR, is that cash on cash?
Okay, the question is, does the private equity firm that wants a 20% internal rate of return, is that cash on cash?
It is, yeah.
Yep. Yeah, it's nice to be an LP in a well-run private equity group. And the kind of money that's out there, the database, we subscribe to tons of databases. We ran a list of family offices, American family offices. These are people just managing family wealth. Anybody want to guess how many multi-million, sometimes hundreds of $million family offices there are in the United States? Does anyone take a venture a guess? 5,000. More than 5,000 families that have offices, and they hire people like us, or they get somebody a lot sharper than us who just got out of Wharton or one of the Ivies, and they put together a little family office and they look for deals. And we get 3 to 5 emails a day looking for deals. And they're family offices, small boutique investment firms, small boutique private equity groups, and they're looking to invest money. They want to put money to work. So we've exhausted you. Well, we moved through a lot of stuff. We're easy to find.
Yep.
My columns generously in the magazine every month. We have a book we can give you. Give me your business card. If you want to have a confidential conversation, we can sign an NDA. Not here, of course, but later down the road, we'll put an NDA in place and give you a call. We have a valuation service. It's very low cost, and that's a credit toward our retainer. It's $5,000 to value your company. And then we can tell you how we engage. Rick, thanks for having us again.
Thank you very much,
Appreciate
by the way,
it.
too.